Ladies and gentlemen, Asian guy here. Stop what you're doing and listen closely. If you want to know when a global conflict is actually starting, ignore the mainstream media. They want you watching aircraft carriers, fighter jets, and troop movements in the Taiwan Strait. Military assets are theater, designed to be seen. When a superpower wants to signal strength, they move a ship. When they're preparing for an irreversible divorce, they move their debt. Debt is the bedrock of the global order. It's slow, heavy, and almost impossible to move quickly without alerting the entire world. Yet data just hit the desk from the US Treasury Department, and it confirms the unthinkable. China is dumping American debts at a speed that defies every rule of economic logic. This isn't portfolio rebalancing. This is a burn notice. They're clearing the decks for a world where the US dollar is no longer a store of value, but a strategic liability. Today, we conduct a forensic deep dive into the $688 billion exit. We need to examine the Treasury International Capital Report, the TIC data. It's the most boring, dense document in Washington, but it contains the DNA of the collapse. Most analysts read headlines. We're going into the footnotes. As of October 2025, China's holdings of US Treasury bonds have cratered to $688 billion. To the average person, that sounds massive. But context matters. In 2013, at the height of the symbiotic relationship between Washington and Beijing, China held $1.32 trillion. They were the primary financiers of the American deficit, buying bonds that allowed Americans to buy their cheap goods, a closed-loop system keeping your interest rates low and the global economy humming. That loop is now officially shattered. China has liquidated nearly 48% of its total position. But here's the part that should keep you awake at night. They're selling these bonds during a historic market drawdown. In finance, you only sell a depreciating asset at a loss if you're desperate for cash or if you believe the asset is about to become toxic. China is swimming in cash. They don't need liquidity. That leaves only one conclusion. They believe the US Treasury bond is about to become a hostage. The numbers tell the story. From 2013 to 2025, China has been methodically reducing exposure. The pace accelerated in 2022, but the real alarm is in the trajectory. This isn't rotation. This is liquidation. When you see a creditor nation taking 20% haircuts on hundreds of billions in bonds, you're watching strategic repositioning for conflict, not economics. Look at the monthly data. Every single month for the past 18 months, China has been a net seller. No pauses, no reversals, no wait and see. They're following a predetermined playbook, and that playbook has a clear endpoint: zero US Treasury exposure. Why would China accept massive losses today? Because they watched what happened in February 2022. When Russia crossed into Ukraine, the West executed a financial maneuver that changed history. They froze $300 billion of Russian central bank reserves with a few keystrokes. Beijing took notes. They realized their $1.3 trillion in US debt wasn't an asset. It was a leash. The moment conflict goes hot in the South China Sea, that $688 billion becomes a donation to the US Department of Justice. It goes to zero. So they're exiting now, regardless of price. They're trading fake wealth, digital credits in a New York custodial account, for real wealth. They're dismantling the Great Wall of debt that stabilized the US economy for 2 decades. Think about the mechanics. These aren't bonds sitting in Beijing in a vault. They're entries in the Federal Reserve's custodial system. The US controls the ledger. In a conflict scenario, the Treasury Department can freeze those assets before Beijing can even log into their account. This is the ultimate vulnerability for any adversary holding dollar-denominated debt. Russia learned this lesson the hard way. They held $600 billion in reserves spread across Western financial institutions. Over half vanished overnight. Not through military action, through database entries. China watched their strategic partner lose $300 billion without firing a single shot. That's a lesson you only need to learn once. The rational move for Beijing is clear. Liquidate the hostage position before it becomes leverage against you. Accept the loss, take the haircut, and redeploy into assets your adversary can't confiscate with a phone call. As China exits, the burden of funding the US deficit is falling on a new, desperate group, the Bagholder Alliance. If China is selling, who's buying? This is where the math gets dark. Look at the TIC data for the United Kingdom and Belgium. The UK's holdings have surged to over $750 billion, making them a larger creditor than China. Ask yourself, how does an economy 1/16 the size of China, running a trade deficit, find $750 billion for US debt? They aren't using profits. They're using financial engineering in the City of London. Then there's Belgium. Holdings spiking toward $370 billion. Is the Belgian government suddenly wealthy? No. Belgium is home to Euroclear, the plumbing of the global financial system. These aren't market buyers. These are proxies. This is financial conscription. Washington is telling NATO allies, if you don't absorb the supply, China is dumping. the bond market breaks, and we can't protect you. We're moving from a global reserve asset to a NATO reserve asset. The pool of buyers is shrinking while debt issuance is exploding. Let me break down the mechanics. When China sells a treasury bond, someone has to buy it. If market buyers don't step up, yields spike. Rising yields mean higher borrowing costs for the US government, which means the deficit explodes faster, which means more bonds need to be issued, which creates a death spiral. To prevent this, the Federal Reserve and Treasury Department have a playbook: lean on allies. The UK and Belgium aren't buying treasuries because they want exposure to US debt. They're buying because they're being told to. This is the geopolitical tax of the alliance system. Euroclear in Belgium is particularly interesting. It's a clearinghouse where institutional investors park their trades. When you see Belgium's holdings spike, you're not seeing Belgian demand. You're seeing coordinated buying through the Brussels node by multiple NATO entities trying to disguise the bailout. Japan is the other major player being squeezed. They hold over $1.1 trillion in treasuries, the largest foreign holder. But Japan has its own crisis. The yen is collapsing. If Tokyo is forced to sell treasuries to defend their currency, the game is over. That's when the Fed will be forced to print trillions to monetize the debt directly. The bag holders are allies with no choice. That's not a market. That's a hostage situation in reverse. Where's China putting the cash? They aren't buying euros or yen. They're converting paper claims into physical reality. Gold. The PBOC has been a relentless buyer for over 18 months. They're moving toward collateral-based reserves that can't be frozen by SWIFT. Gold is the ultimate non-confiscatable reserve asset. It doesn't exist in a ledger controlled by your adversary. Energy. They're filling their strategic petroleum reserve to 1.5 billion barrels. They're building a buffer to survive a naval blockade. If the Strait of Malacca closes, China needs enough oil to keep their military and economy running for 12-18 months while they secure alternative supply routes. Copper. Even with their real estate market in depression, copper imports are at all-time highs. Why? Because you need copper for munitions, drones, and the green energy grid. They're cornering the market on inputs for the 21st century military-industrial complex. Copper is the war metal of modern conflict. Food security. China now holds 60% to 70% of global grain reserves. They have enough corn and wheat to feed their population for over a year without imports. They're trading yield for calories, interest for survival. Let me make this concrete with numbers. China's gold reserves have officially increased from 948 tons in 2019 to over 2,300 tons in 2025. But many analysts believe actual holdings are significantly higher because Beijing is buying through proxies to avoid telegraphing their strategy. Every ounce of gold is one less dollar of dependency. On energy, the math is stark. China consumes roughly 15 million barrels of oil per day. A strategic reserve of 1.5 billion barrels gives them 100 days of full consumption with zero imports. But in wartime rationing, that stretches to 6 to 9 months. That's the buffer they need to fight through a blockade scenario. Copper is the silent killer. China is importing 450,000 to 500,000 tons per month despite construction activity being down 30%. The gap between consumption and imports is going into strategic stockpiles. When you stockpile the raw materials of war during peacetime, you're not planning for peace. Food is the ultimate vulnerability for any nation. China learned this lesson during the Great Famine. They will never again allow their population to be dependent on foreign grain during a crisis. Holding 70% of global reserves isn't about profit, it's about sovereignty. A nation at peace chases ROI. A nation preparing for conflict chases resource security. China is trading financial assets for survival assets. That should tell you everything about their timeline. The divorce is finalized. We're just waiting for the house to be sold. Here's how you protect yourself using the Sterling Protocol. Rule 1. Shorten your duration. Do not hold long-term U.S. government bonds or ETFs like TLT. As China exits, structural pressure on interest rates is upward. If you need safety, keep cash in short-term T-bills, 1 to 6 months, which have almost zero duration risk. Be like China, get liquid, get short-term. Duration risk is the silent wealth destroyer in rising rate environments. A 30-year Treasury bond loses roughly 20% of its value for every 1% increase in rates. If rates spike from 4% to 6%, you're looking at 40% drawdowns. Short-term bills avoid this completely because they mature before rate changes can hurt you. Rule 2. Follow the smart money into commodities. China is selling paper to buy stuff. You should too. Own the producers of energy and metals. If China is hoarding copper, own the miners like Freeport-McMoRan. If they're hoarding gold, own the metal. Own the stuff, not the currency that buys the stuff. Physical commodities and commodity producers become the ultimate inflation hedge when central banks are forced to monetize debt. When the Fed has to print to cover treasury auctions that fail, that money floods into real assets. You want to be positioned in those assets before the money printer turns on. Rule 3, watch the allies, monitor the British pound and Japanese yen. If Japan is forced to sell treasuries to save the yen, it's game over for the bond market. That's the moment the Fed will be forced to print trillions to monetize debt, and that's when the inflationary loop goes vertical. The yen is your canary in the coal mine. Japan holds $1.1 trillion in treasuries, but faces a currency crisis. If Tokyo chooses currency stability over US debt holdings, they'll dump treasuries to buy yen. That selling pressure will spike US rates, which will force the Fed to step in as buyer of last resort. That's the moment paper currency dies and hard assets soar. Rule 4, build your own strategic reserve. You don't need a billion-barrel oil stockpile, but you need diversification out of pure dollar exposure. A mix of physical precious metals, commodity exposure, and short-duration cash positions gives you the flexibility to survive the transition. The $688 billion figure isn't just a statistic, it's a countdown clock. China is clearing the decks. The question is, why are you still standing on them? This is Asian Guy. The protocol is active. Hold the line. I'll see you in the next briefing.